Hi everyone! So many people asked me for a video on investment property, so here it is. My two previous videos looked at property from an occupant's point of view and then determined whether it's better to buy or to rent a property. And this video specifically looks at investment property from a landlord's point of view, and at which point are you better off investing in property or investing in the stock market. I will also map out different scenarios and determine a threshold so that you know how much rental income you need on a property to make it a worthwhile investment. And then in this case, I established the 13% rule, which is the rental income on a property needed, in my opinion, to make it a worthwhile investment, and below which you are probably better off just investing in the stock market. So just a quick intro, if you're new here, I'm Carla and I'm a chartered accountant and investment professional with 10 years of experience in the finance and investment industry. And I've worked in multiple countries, including South Africa, the UK, Netherlands, and I'm currently in Switzerland. You can follow along on my Instagram or subscribe to my YouTube channel if you're keen on making smarter money choices and building wealth for yourself. And also a disclaimer, this is not personal investment or tax advice, so always do your own research. So how are we approaching this? I'll analyze this in three scenarios. The first being only acquiring an investment property and not investing the cash flow generated. The second being acquiring the property and investing the cash flow generated into the stock market. And the third being only investing in the stock market. Something that makes property a unique asset to own is that you can use leverage to acquire a property. And that means that you borrow money from the bank at a cost to buy a property which generates a cash flow for you. But obtaining leverage on a stock market portfolio is not as easy and accessible to the public as obtaining leverage on an investment property. So a property investment has two return components to it. Firstly, there is a capital appreciation on the asset, and secondly, it generates cash flows from rental income. On the other side, a stock market portfolio also has capital appreciation and dividends. But something that is quite unique to a stock market investment is that you can easily get global diversification in your stock portfolio. Whereas if you buy a property, the risk is quite concentrated to the area, the country, and the currency that the property is in. So on the stock market investment, why do I mention this? I think it's crucial to get international diversification on your stock portfolio. And this is regardless of where you live. For example, I live in Switzerland and very little of my stock market investments are in Swiss companies. Because if we look at this image, you'll see that the capital markets in the US make up almost half of the global stock market. And if you're in South Africa, for example, South Africa only makes up 1.3% of the global stock market. So if you want to be a smart investor, in my opinion, you need to invest in a way that you gain exposure to the global stock market and not concentrate your risk on one country. So the first scenario, to model this out, I'll use a purchase price of 1 million rand on the property, and I'll use a 22-year average on the prime interest rate, which is 10.67%, less 1%, because we're at the high end of the interest rate cycle right now, and because we're forecasting this for 20, 30, 40 years, we want to use a longer term average interest rate. And also banks tend to give mortgages at prime less 1%. So the interest rate is 9.67%, and it's a mortgage for 20 years. The deposit is also assumed at 10%, which is 100,000 rand, and you will also see that there are other costs related to this property. So the initial cash flow needed to buy this property is 164,000 rand. And in the first case, I'm going to assume that the annual rent is equal to 12% of the property value. Other expenses that the landlord can expect are repairs and maintenance at 1% of the property value, rates and taxes at 0.5%, levies and insurance at 1.5% of the property value. This is dependent on quite a few factors like the location and the type of property, and I've seen levies much higher and lower. And on the insurance, banks will require you to take out insurance if you've got a mortgage. So the rental income assumed is 12% gross, so that is before any of these costs are deducted, and this also assumes no estate agent fee. So if there's an estate agent involved, this has to be added on top. The assumption here is that rent increases with 5% every year, which is the national average since 2012, excluding outlier periods of COVID. And there is also a tenant vacancy and default rate that has to be considered, because tenants might not pay, but also when tenants move out, the property might be vacant for a month or 2 months before new tenants move in. And the national average for this is 5.5%, but I'm going to model this on 4.2% because let's assume that you are able to get a good tenant, you've got a good relationship with a tenant, and this 4.2% would basically mean that the property stands vacant for 1 month every 2 years. Then of course there also has to be tax on the rental profit, and the tax will be calculated on the rental income less all of the costs associated with that, including the interest on the mortgage. And I've run an amortization table to calculate the interest on the mortgage for every year. So yes, there are quite a lot of assumptions involved here, and we also have to make assumptions at one point if we want to be able to model and forecast numbers to make decisions. And it's impossible to cover all of the potential scenarios. You will see that for the first 13 years, this investment is not cash flow positive. And that's because even though the rental income covers the mortgage payments, it doesn't cover all of the other costs associated with owning the property. So in this case, the property investor would actually need more than just the deposit and the upfront costs to be able to maintain this investment. So we are going to allocate just enough cash to him to allow him to make this property investment, which is going to be 240,000 Rand in cash. And that will be invested in a notice deposit account so that it's liquid and he can withdraw from this as he needs the money. From year 14 onwards, the cash flow on this investment is positive, and it significantly ramps up after year 21 once the mortgage has been paid off. So now to determine if the property investor would have been better off just investing in the stock market from the start, or whether these cash flows generated by the property actually make it a worthwhile investment. And now I have to explain which stock market returns I'm going to use as a benchmark. And obviously, historic returns in the stock market does not necessarily guarantee returns in future, but the best we can do is use long-term averages to forecast this. So again, I'm going to use a global stock market index, and in this case, the MSCI All World Index, because it's possible to invest in an exchange-traded fund that tracks the global stock market, and it exposes you to more than 1,400 companies across the world, and it represents 85% of the global investable equity opportunity. So this is truly a diverse way to invest, and I'm not cherry-picking stock market returns. Otherwise, I could be using the S&P 500 returns, which have been better than the MSCI All World Index. So if we look at the MSCI All World Index returns since 1987, that's 37 years, the annualized return is 14.5%. We need to consider the movement between the US dollar and the rand. And in 1987, a dollar cost 2 rand, where now it costs around 18 rand for a dollar. So if we look at one of the local ETFs in South Africa that actually tracks the MSCI All Index, this actually matches exactly their 10-year annualized return. So yes, the return of the MSCI index since 1987 covers the dot-com bubble burst, the global financial crisis, and also the decline in the stock market during the COVID pandemic. Now I've shown you how we got to the 14.5% return, but to use this return, we also need to consider fees. And in this case, I'm going to assume a 0.5% fee, which is actually on the higher end of fees I have seen on index ETFs. And these fees are crucial to consider if you're a long-term stock market investor. Have a look at a video that I did specifically on this to discuss what it means to be a passive and active investor and why fees are very important. Anyway, so we're assuming a 0.5% fee, which in my opinion is quite high, and that gets us to a net return of 14% that we'll use in this analysis. So what about tax? So many people asked me about tax in my previous video, so don't worry, in this scenario, I consider all of the potential tax elements. It is worth noting, because this is an investment property, there is no primary residence tax exclusion, and on the stock market side, we can be smart about tax on stock market investments. The first is investing in an accumulating ETF instead of a distributing ETF, because when you invest in an accumulating ETF, dividends are reinvested and it doesn't pay out, which is great for compounding, but also for tax, because the gains will be taxed as capital of nature, and therefore these gains will only be subject to capital gains tax. There are also two additional tricks. The first is if you invest in a US dollar-based ETF, only the gains in US dollar would be subject to capital gains tax, and not the gains attributable to the rand depreciating to the dollar. And the second thing is allocating some of this investment in your tax-free savings account would mean that these gains would also not be subject to tax. But in this case, I'm going to consider that all of the gains are taxed as capital gains tax, including the gains attributable to the rand dollar movement. I just wanted to mention these tips in case it could be useful to you. And just something else to consider is on the sale of the property, there are usually also estate agent fees involved, and I've assumed that at 5% of the property value, including that. Okay, so back to the investments. We're going to assume that the value of the property increases with 6.5% every year, which is equal to the residential property price index issued by Stats SA since 2010. So let's forecast the value of the property for the next 40 years. It goes from 1 million to 12 million in year 40. The 240,000 in cash that was allocated to the property investor allow him to build up this asset could have also been invested in the stock market. And the stock market investment would have grown from 240,000 to 45 million in year 40. So let's consider the tax on that. After the capital gains tax and selling costs on both these investments, the property would be worth 9.8 million and the stocks would be worth 37 million. But the property investor also generated cash flows, which once they became positive, he started investing in the stock market. So let's look at what the stocks and property portfolio looks like and how that compares to the stock market only investment. So in year 14, the property investor starts investing his cash flows in the stock market. And by year 40, the stocks and property portfolio is worth 27.5 million, which after tax is 22.8 million. Therefore, the stock market only investment in year 40 is actually worth 14 million more than the stock and property investment. And this is after tax. But how is that even possible? The early investment of the stock market investor is so crucial because the compounding impact of returns is massive. And this is not something that I can say enough. The impact of time and compounding on your investment portfolio is insane. So it's so important to get started investing as early as possible. Because in this case, even though the property investor generates extra cash flows and those are invested in the stock market, he can never catch up to the investments in the stock market that was made 13 years before. If you want me to do another video to understand compounding better, let me know in the comments. But Warren Buffett, which is one of the most successful and well-known investors in the world, calls compounding the greatest force of nature. And you should start making this work for you too. Because you can see these charts are exponential and you want to get money in as early as possible. Because based on these assumptions, and I have to remind you, these are assumptions, it's not guaranteed that it will perform like this in future, 240,000 Rand invested at the start would be worth 2.7 million in 20 years time, 10 million in 30 years time, and 37 million in 40 years time. And this is after tax, which shows you that the compounding and exponential nature of these returns are insane. So in the next scenario, we're going to look at if you're able to acquire a property in an area where rent increases with 7% per year and the value of the property also increases with 7% per year. What does that look like for the property investor, the stock market investor, and if the property investor also invests his cash flows in the stock market? So all of the assumptions remain as before, except for the increase in the property price and the increase in the annual rent. And you will see that the property owner, which also invests in stocks, is actually better off than the stocks only portfolio. But in the case of just investing in the property, that doesn't come close to bringing the stock market returns into the portfolio. So after 40 years, after considering tax and selling costs, the property investment would be worth 11.8 million. The stocks only investment would be worth 37.2 million and the stocks and property portfolio would be worth 52 million. So that's 14 million more than just investing in the stocks. So in this case, the stocks and property portfolio is much better off than the stocks only portfolio. But the worst case is just doing the property and not investing those cash flows that it generates. I think it's clear now that getting stock market returns into your portfolio is crucial. So now drum roll, please, for what I call the rule of 13%. So this scenario, we're modeling off of the original assumptions, which is based on national averages, and that is a 5% annual rent increase and a 6.5% annual property price increase. And we model out 4 different rental income scenarios. If the gross rental income is 12, 13, 14, and 15% of the property value. So this is the gross rent before any of the costs are deducted. And you will see at year 31, there is a break-even point where the stock portfolio overtakes the 13% line. And this 13% line assumes the gross rental income at 13% and that all of the cash flows generated by the property are invested in the stock market. And it also includes the value of the property over time. And all of these values are after tax. And in this case, a reasonable conclusion would be that if the property doesn't generate a gross rental income of 13%, you would probably be better off investing in the global stock market. And to this, estate or rental agent fees need to be added. So if you have an agent taking 10% of the rental income should be 14.5% gross, which would give you 13%. So in my opinion, below the 13% threshold, you're probably better off just being a passive investor in a global stock market index. And above this threshold, you could consider becoming a property investor as well, but it is crucial to also invest the cash flows generated into the stock market to be able to get that compounding return effect. So what about a scenario in which the rand doesn't depreciate against the US dollar as much as it did over the last 22 years? And in this case, I'm going to assume that there's a 25% less depreciation of the rand against the dollar, and that would mean a 4.5% annual average depreciation instead of the 6% 12% that we used before. So if we model this out at an 11, 12, 13 and 14% gross rental income on the value of the property, you will see that there is a break-even point in year 27 where the stock market portfolio overtakes the 12% line. And this brings us to the 12% conclusion. So if you believe in the future the rand will not depreciate as much against the dollar, you could use the 12% rule, which in my opinion means that above 12%, investing in a property could be worthwhile if you also invest the cash flows generated into the stock market, and below which you're probably better off being a passive investor in a global stock market index, which in the case of the MSCI All World Index gives you exposure to 1,400 companies across the world. And then again, if there is an estate agent involved, which takes 10%, for example, this threshold increases to 13.3% of gross rental annual income, which you need to earn on the property to make it, in my opinion, a worthwhile investment. But it is very clear that only investing in the property and not investing the cash flows into the stock market would definitely not put you in the best position. So now just some closing comments and observations. And of course, there are many assumptions and variables considered in this calculation, but I try to use as many reliable and long-term averages as possible. I also think that there is other potential in being a property investor where you, for example, flip properties, acquire them, renovate them and sell them for a profit. I do hope that some of your profits are invested in the stock market though. But if you've got any stories on flipping properties and how much money that made for you, please let me know in the comments. I also know that being a property investor takes a lot of work and finding good tenants is not always easy. And also, if you are a young investor, I really would encourage you to get some exposure to the stock market. Have a look at my previous videos because the compounding impact of returns are just so crucial. It's also worth noting that properties and real estate are different asset classes with different risk profiles because the real estate asset class does not have as much volatility as the stock market, even though there is less growth. But on the other side, real estate assets are not liquid and it could take months to sell if you need to. Whereas if you are invested in the stock market, although generally investing in equities in the stock market are also long-term investments, you could sell stock market assets much easier and get access to those funds within a day. And again, these stock market returns that I use are not selective and not cherry picking. This is a return of the global stock market index net of fees, and this is accessible to the average investor in South Africa. There are broker platforms that you can invest in these ETFs. If there is something else you would like me to make a video on, please let me know in the comments. And also please share your success or failure stories if you're a property investor, because others could learn from you. I look forward to seeing you next time.